Despite the fact that the current power crisis will have a considerable impact on miners, there remains some hope that the present macroeconomic circumstances would favor the cryptocurrency business. Welcome to CryptoLink channel. If you love getting news and updates about cryptocurrency, join our community by subscribing to our channel. You can tap the bell icon to never miss our new videos. If you enjoy our channel, kindly like and share it with your friends. October 25, 2022. Cointelegraph tweeted, "As of recent, oil, gas, and electricity prices are no joke. So, will the emerging energy crisis affect the crypto markets? There is no avoiding the fact that the world is currently experiencing an unprecedented energy crisis. This crisis has become even worse in the wake of the COVID-19 pandemic, to the point where many nations, particularly those in Europe and North America, are suffering serious shortages and sharp increases in the cost of oil, gas, and electricity. The current conflict between Russia and Ukraine has resulted in limited gas supplies, which has led the cost of necessities like fertilizer to rise. Additionally, it has led to a rise in the consumption of coal as well as other natural resources. Europe alone had a 14% increase in coal usage last year, and another 17% increase is anticipated by the end of 2022. To better clarify the situation, it is important to point out that European gas prices are currently around 10 times higher than their standard level over the previous 10 years, hitting a record high of roughly $335 per megawatt-hour in late August. Similarly, according to the newly released winter fuel projections for 2022 from the United States Energy Information Administration, the average price of gasoline for Americans would rise by a startling 28% compared to previous year, reaching an astounding $931. With such startling information in the public domain, it is worthwhile to investigate how this prolonged energy deficit may impact the crypto industry and whether its negative impacts will subside anytime soon. Experts' discussion on the matter. According to Matthijs de Vries, Chief Technical Officer and founder of AllianceBlock, a blockchain company that bridges the gap between conventional finance and decentralized finance, informed Cointelegraph that a number of issues, such as the electricity crisis, the impending recession, the rising inflation rate, and the escalating geopolitical tensions, have contributed to the poor state of the global economy. These problems are connected, particularly in the manner in which capital enters and exits important industries. The amount of capital flowing into and out of the market for digital assets decreases as the macroeconomic environment gets worse. The blockchain's incentivization processes can only function as long as there is this liquidity. Accordingly, if there is a liquidity shortage, miners will have fewer transactions to complete, pay lower fees, and receive lower incentives. De Vries also thinks that rising energy prices may give miners greater motivation to switch to Ethereum 2.0's validator ecosystem, which uses a proof-of-stake or POS mechanism that is much more energy efficient. Yuri Snigger, CEO of ExtraChain, a provider of infrastructure for distributed applications, blockchains, and decentralized autonomous organization or DAO platforms, shares a somewhat similar outlook and predicts that the current increase in energy prices will have the greatest impact on proof-of-work or POW blockchains. He stated that they are largely reliant on the energy industry. POW will eventually fail because, in my perspective, a blockchain's value shouldn't stem from the pointless use of energy. A worsening macroeconomic environment will harm cryptocurrency soon. The creator of the cryptocurrency YouTube channel Dapcenter, Nero J, said to Cointelegraph that since the difficulties currently being faced will remain to have a negative overall influence on the cryptocurrency market, most investors will keep viewing this still emerging industry as speculative and unsafe, at least in the near future. As a bright spot, he pointed out that the difficulties might present a chance for greater crypto adoption, particularly given that many nations continue to suffer from hyperinflation and sanctions, such as Argentina, Turkey, Venezuela, Zimbabwe, and Sudan, which might offer crypto assets more functionality and use cases. Lastly, Jay thinks that the deteriorating energy situation might lead to further examination of the mining industry, particularly since those who support the zero-carbon emission movement will now have more reason to be skeptical of the industry. He said that The potential environmental effects of cryptocurrency mining are being questioned by many. The encouraging news is that several cryptocurrency projects, like Ethereum, have already been developing their blockchain networks extremely efficiently and based on low-carbon emission technologies. The cost of Bitcoin and how it correlates to the energy market. Externally, higher energy costs will result in higher costs for miners, who may then be forced to sell any Bitcoin they own, bringing down the price. Additionally, increased production may force miners to raise their rates in order to finance their daily operating expenses and, in rare situations, even compel them to completely cease operations or sell their equipment. Trend reversal's hope remains. According to Wiener, the oil crisis may exert pressure on the price of Bitcoin, but the surprisingly weak condition of the world economy may be able to offset this. Wiener asserts that in the current state of the world economy, the monetary policy of the U.S. Federal Reserve has had the greatest impact on the cryptocurrency industry. Institutions have digitized their back offices and boosted their Bitcoin acquisitions since the Federal Reserve began implementing a loose monetary policy in 2020. Institutions modify their allocation strategies to include Bitcoin as a value-preserving asset when fiat depreciates. In addition, he pointed out that the S&P 500 and Nasdaq are growing more and more associated with the cryptocurrency market, particularly Bitcoin, but the correlation between oil, energy, and electricity will be insignificant unless a future worldwide electricity shortage affects Bitcoin mining. The continuing energy crisis may drive additional government expenditure initiatives, leading to the printing of additional currency to bail them out. This can lead to a decline in trust in fiat assets and a rise in demand for virtual currencies. Given that this tendency is currently evident in many developing countries and has the potential to spread to some of the world's more developed economies, it is not out of the question whether it will occur in the future. Inflation just reached an all-time high in the Eurozone of 8.9%, a trend that was also observed in the US, where it spiked to an all-time high of 8.5% last August, marking a 40-year high. And even while there is still much disagreement about whether the stimulus packages have had a positive or negative effect on the world economy, just the concern about rising inflation is enough to fuel demand for cryptocurrencies. In light of this, it will be intriguing to watch how the coming years of the digital asset market develops as we move toward a time of potential energy scarcities and price increases, particularly in light of the fact that surging geopolitical tensions and declining economic conditions are only making things worse. That's it for our today's video. So, what can you say about the news? Let us know about it in the comments section down below. Thanks for tuning in to CryptoLink. We are always excited to provide you with news and updates about cryptocurrency, and if you like this video, please click the like button. See you on the next one.